We might maybe touch 28K, but the fact that we've ranged so much and we're starting to consolidate up in the upper corner as opposed to the 0.5 probably means we're not going to go below 30K again. All right, what's up folks, and welcome to CryptoFAQs and our first update on the state of the market. So today's goal will be to talk through how Bitcoin went from a price of around $65,000 per coin to a range between 30 and 40,000 over a matter of a few days. How did we get there? What were the drivers? And what does this mean for us going forward? So we can do that through this agenda. We'll first take a look at the Fear and Greed Index to get a high-level understanding of how folks feel about everything going on. We'll then talk about leverage and market sentiment, tie those two together to understand how we got to where we are. We'll also talk about Bitcoin reserves from the perspective of miners and exchanges. Now, these two institutions interact with Bitcoin differently and are motivated differently by Bitcoin than, say, banks or tech companies that just want to buy in low. We'll also do some weekly and daily technical analysis, and we'll talk about in this section why exactly we're not doing anything on a lower time frame. And we'll wrap up with some conclusions. What are the takeaways from what we talked about, and how do I feel about the future? So currently the Fear and Greed Index is extremely low. Last I updated this chart, we're at 30, so we've been ranging between 10 and 20. We recently crossed over 30 in June, so we are beginning a bit of a recovery. This range between 10 and 30 is the lowest we've seen since March of 2020. When we began the COVID-19 pandemic, that was a shock to the global system. Everything was pretty much fearful, but we're pretty much getting out of that now. And 15 months later, crypto is back to the same level. It's helpful to take a look at how we got there to understand why exactly we're still ranging at such a low level. At the beginning of the year, from November to January 2021, for 2.5 months, basically, the index was pegged at over 90 points. And this makes sense because the price just kept going up and up and up, reaching new highs almost every day. And people developed these unrealistic expectations about the parabolic growth that we saw. And then over the next few months into late April, the price of Bitcoin consolidated down to $50,000. Didn't really go up, it just sort of ranged for a long time. So it makes sense that we lost a third of the index, as there really wasn't any price action to be greedy over. But then seemingly out of the blue, in a matter of just a couple of weeks, the index fell by more than half to below 30 points in mid-April, and it's been there basically since June. So a very long consolidation at a very different level. We had a step function decrease. And the question then becomes, why? And the answer to that might lie within high leverage. Unprecedented retail access to leverage in the markets can cause dynamics that we haven't really seen before. And that's especially the case in a market like crypto, which already experiences insane volatility. So if we take a look at leverage throughout 2021, you'll notice that on April 16th, we peaked at a leverage ratio of around 16%. This means that 16% of all Bitcoin across all exchanges had some sort of leverage open against it. And then a month later, on May 19th, that ratio declined by half. That's huge. We went from 16 to 8%. We haven't seen 8% in this entire chart, at least until July 2020, and likely before then as well. More recently, we've settled around 10%, which means this ratio has climbed up pretty significantly over a short period of time, but we should take a look exactly at how we initially declined by 50%. This is a daily trended chart of long and short liquidations since early March. And you'll notice that the green bars here, we'll focus on these. They are by far the biggest in this chart. In fact, these two green bars in mid-April and mid-May are the biggest we've seen in crypto history. So we'll dive into these in a couple slides. But first I want to set up the scene and explain how exactly we get such large liquidation events. You can see 9.25 billion, a little bit more than that here. Essentially, retail nowadays has very easy access to insane amounts of leverage. 10x, 100x is kind of the marketing term, but you can do anything from 2 to 100x on exchanges like Huobi, KuCoin, Binance, Bybit. Those are just a few names that come to mind. Crypto already is an extremely volatile market, and leveraging 100x generates a much higher volatility property, especially for retail investors that don't have, entire staffs of bankers and analysts putting together risk-adjusted strategies, let alone millions of dollars to make do on margin calls that can occur with just a small bit of movement after leveraging 100x. So price action as a result of leverage is magnified so much that pretty much everybody gets margin called to the point where they can't afford to put in more assets to keep everything that they originally borrowed. The first big green bar we saw was on April 17th, where $9.25 billion worth of long contracts were liquidated. And you can see here on the right all the exchanges that were part of it. Most of it came from Binance, but again, a lot of familiar names: OKX, Huobi, Bybit, Deribit, FTX, etc. 50% of this 9.25 billion was for Bitcoin. Only 10% at this point was for Ethereum. The rest of the 40% was spread out throughout crypto as things hit the fan, and we just kind of saw, a cascading effect throughout the market. This is the biggest liquidation event in Bitcoin history. But if that weren't enough, basically 30 days later, on May 18th, we had another gigantic long liquidation event worth $7.6 billion. This time, over 25% was for Ethereum. So a 2.5x increase in a matter of a few days. And 40% of that was for Bitcoin. So for Bitcoin, basically the exact same thing happened. Finally, to top it all off, in between these two events, another $22 billion of long contracts were liquidated in between. So in total, over this single month, $39 billion worth of long contracts were liquidated over 32 days. That averages out to a daily rate of nearly $1.25 billion. That's huge, because you can notice that most of these green bars are nowhere near that rate, let alone consistently every single day, that much liquidation. So how does this happen? Well, high leverage, like 10x or 100x is a great example, doesn't really require that much downside volatility to trigger margin calls, meaning the price only has to fall by a little bit for your leverage ratio to get so out of whack that the exchange says, hey, put up more money or we're gonna take everything away. And the banks, they're the ones with sufficient enough liquidity to inject into the market to counteract these longs and cause the price to go down just a little bit in order to trigger a cascading effect of margin calls that most folks just don't have the capital to fulfill. So a sense of scale, as if $39 billion wasn't enough already. $39 billion worth of long liquidations is equivalent to 1.5% of the crypto market cap at its peak here on May 11th. That's $2.56 trillion. So just to be clear, there's nothing to be conflated here between when this liquidation occurred and the peak of the crypto market cap. It's just to give you a sense of scale that 30 days of liquidations can actually be worth a lot. 1.5% of the entire crypto market cap is quite a seismic event. Another point of view is DeFi. DeFi lost 43% of its total locked-in value in just 12 days. $39 billion worth disappeared from DeFi. That's $3 billion a day between May 11th and May 23rd. You can see the value fell from around 90 billion to around 50 billion by the end of May. And so people were scared as the price falls, they want to get out before everything else crumbles. So more people sell, so the price falls more. It's a self-fulfilling prophecy as everyone is freaking out. And a big reason is the fact that there's so much negative or conflicting sentiment in the news. Here's just a selection of a bunch of random articles that I read or came across and could find again that doesn't bode well. You can see, some of these headlines. And then a few of them are also conflicting. On this one right here, Goldman Sachs is saying Bitcoin is officially a new asset class. So this is somewhat positive. It's investable, and a company like Goldman Sachs saying it's investable is probably a good thing. But at the same time, the commodities boss is saying Bitcoin is risky. It's not digital gold. It's more like digital copper, which means it sucks. And so when you read something like that from supposedly a trusted source like Goldman Sachs, you don't really know what to think. Same thing happening with Scott Minerd and Guggenheim. There's a lot of geopolitical stuff with China banning Bitcoin. There's a lot of second and third order effects, like the environmental effects of Bitcoin and whether or not it incentivizes clean energy or not, and all the stuff between Elon and Cathie Wood. There's so much noise going on that it's hard for people to really even ground themselves in some sort of truth and figure out where to go over the long term. So cutting through all the noise, where are we now? Well, I think the worst may actually be behind us, and there's several things that tell me that. The first of which are exchange reserves. So this is the amount of Bitcoin held in exchanges wallets. And you can see in early May, that started to tick up quite rapidly. But as of late, that's been decreasing finally, and that's a great sign, because that means coins are being pulled off the market. That means people are okay with finally putting their coins into cold storage, or at the very least, they're not being liquidated and flooding the exchange wallets with more coins. Just to be clear, it is still possible for re-leverage to occur and go beyond that 10% we talked about earlier if that $39 billion worth of liquidation wasn't enough to scare everyone away from being over-levered. But I do think this is unlikely because, again, that liquidation event was unprecedented in the 12-year history of crypto. Another important perspective are miners. They have a very different incentive. They interact with Bitcoin in ways that are different than banks because they are better off with a higher price in the sense that when they sell off to cover the cost of their operations, they want to minimize how much they sell. For the most part, since the beginning of 2021, all miners have done is accumulate. And even throughout these two big drops, they continue to keep their Bitcoin. So they're not worried about the price falling over a long period of time. There is a little bit of an anomaly starting here where about 5,000 Bitcoin or 5% of total miner reserves was sold off. When I looked at this data, it was classified under unknown miners, so I'm not sure if this is just a miner or several miners that CryptoQuant hasn't classified yet or what exactly is going on there. But in general, this is still just a blip on the radar, and the overall uptrend is still net positive. Now, our last point of view is going to be some technical analysis. We'll take a look at price action, make some predictions as to where the price might go. And we'll start with a weekly analysis. Overall, things look pretty good. We have 1, 2, 3, 4 green candles in a row. We haven't seen that in a while. And especially after these 2 big dips, it looks like things are going pretty good. 3 weeks of positive price action is solid. We are finishing up this 4th week as we speak. And the wicks themselves seem to be shortening, which is all a good thing to see. We're also seeing positive on-balance volume. That's a little bit simplistic here, but I just like that as a confirmation of the volume we're seeing is accretive as opposed to dilutive to the price. And finally, the MACD is beginning its positive inflection. And at the same time, the RSI is steady at 50, which means we're not overbought, we're not oversold, we're just where we need to be, and the price seems to be turning around. We don't have enough data yet to conclude whether or not this is a solid trend, but it doesn't look like the price is going to necessarily crash again, certainly. And it doesn't really look like it's going to go much lower than what we've already experienced. So we've already been through the worst. Now, the next one we'll do is daily. And just some context before we take a look at that, we'll be looking at a Fibonacci retracement from the bottom on March 12th. So I'm doing a very extended Fibonacci retracement to take a look at exactly where the price might range in the near term. So let's zoom in on this peak here. On the daily, you can see that we are testing support and resistance between 382 and 0.5. So between around 40K and 34K, call it 40 to 35K. We've been consolidating there for quite some time, and we've had some dips into what I call the demand zone, which is our previous support range. And that support is right at the January 21 lows. So it makes sense. It's kind of a historic point where we have consolidated at least briefly, and this is a good demand zone for us to continue off of. We didn't test the 618, which is kind of the classic Fibonacci level. Everyone always likes hitting the 618. That level is around $27,000. I don't think we'll go down below 28K. I just don't really see that happening. We might maybe touch 28K, but the fact that we've ranged so much and we're starting to consolidate up in the upper corner as opposed to the 0.5 probably means we're not going to go below 30K again. And also we're seeing the MACD still having a positive trend, but somewhat flattening. And I'm more than certain we're going to continue to retest the 0.5 again and bounce and bounce and bounce as we maybe form some kind of ascending triangle at some point and continue up back on our normal path. As you can tell, this overall chart is showing that we had exuberance here. We reached a point and then we fell back to a more reasonable trend. If you kind of just draw a parallel line between where we're currently ranging and where all this stuff actually started to happen at the beginning of 2021, it's a pretty consistent line. So you can consider pretty much this entire peak to be somewhat of a deviation. And we're back to what would be considered a normal trend upwards. So some conclusions. I don't think we're going to have any more serious dips unless leverage decides to reestablish itself. And I don't think it will because folks are scared. And after an unprecedented liquidation event on the scale of $40 billion, too many retail investors were affected. It's so widespread that I think it's way too soon for folks to go back in blindly and relever themselves to such a degree. At the same time, macro factors or external factors make it very hard to use technical analysis to determine when this consolidation might break. Because Elon tweets when he feels like it, and he can move a market more than 5% within an hour. A hedge fund or a bank can put out a positive or a negative sentiment report on Bitcoin and really affect people's opinions. There can be some more second or third order information about the environmental impact or something that comes out at seemingly a random time. So I don't think it's very smart to use technical analysis to predict when the price is going to change because the variables in play can shift at a moment's notice. So with that unknown, what am I doing in the meantime? Well, I'm staying cool and I'm continuing to accumulate at relative lows. The further down from 40K, the better, because we've been ranging here and I think 40 is kind of the overall level. So anything below that I think is good. If you bought in at the highs, 50, 55, 60, 65, the price is way more than 10, 20% down. You can buy in and just dollar cost average and you'll be all right. So remember, businesses, institutions, banks, tech companies, they're all interested now. And they're trying to put this stuff on their balance sheet. They have so much fiduciary responsibility and so much shareholder red tape that they wouldn't waste their time investigating Bitcoin and manipulating the markets if this wasn't something they were interested in over the long term. And miners, on the flip side, they're not shook. The price fell by like 50% from the peak, and they continue to accumulate at exactly the same rate. They rely on a high price to make sure that everything that they're doing is paid for. So the two biggest players, they're interested and they're spending their time trying to get in cheap. Yes, it's a little dirty that they drop the price, manipulate the markets, but that's nothing new. And all this is showing us that this is becoming more and more serious. So thank you for watching. Please make sure to like, comment, subscribe, hit that notification bell, follow me on @CryptoFAQs on Twitter, and please remember, feedback is your gift to me. These videos get better as I learn more, and these videos get better as you tell me what you'd like to see. More technical analysis, more analysis of coins, more high-level analysis like this. Let me know, and I'll see you in the next one.